Dangote Cement, Nigeria's largest listed company by market value, could spend as much as 20.4 billion naira in its first tranche of a share buyback program that's been penciled for December the 30th. Since the announcement of the share buyback, Dangote Cement has appreciated on the Nigerian Stock Exchange, closing up about 6.3% at 240 naira in yesterday's trading. At that price, the company would be spending about 20.4 billion naira to repurchase its shares, the first tranche of which is set to be about 85,202,537 units, representing 0.5% of the entire current issued shares. Now, what does this mean for the company? What does it mean for other companies that may want to replicate this? And what about the wider equities market? Well, joining me to discuss this is Seyi Omidiora, analyst at Financial Derivatives Company Limited. Seyi, you're very welcome. Good morning. First of all, for anyone that's wondering and watching, what is a share buyback, Seyi? It sounds obvious, but help us define that.
Thank you very much. Now, a share buyback basically is when an organization repurchases its shares back in the open market from either shareholders directly, or it just goes in the open market to buy it back. Now, a company can actually do this for a number of reasons. The first one being to reduce the number of shares outstanding on the market. Another thing is to actually go about a share buy. Another reason why companies go on share buybacks is to improve profitability metrics like return on assets, return on equity. Those are two of the major reasons why companies actually go on share buyback schemes.
Fantastic. All right, great stuff. Thanks for helping us out with that. So, Dangote Cement, most capitalized stock on the exchange, about 4.1 trillion naira. They're engaging in this buyback program while the Nigerian Stock Exchange is posting world-beating returns. Is this the right time for a share buyback scheme?
This question is a bit difficult to answer because it's the first of its kind that we've experienced in the Nigerian equities market. But looking at the US equities market, for example, now share buybacks are a common occurrence there, and even more so when the equities market is on a run. Now, companies actually do this, and they end up buying shares at ridiculously high prices, and maybe because they think their shares are even still undervalued at those prices. Now, coming back to Nigeria or the Nigerian equities market, it is unlikely that this share buyback scheme is going to be foreseeable. It's not something I foresee to happen or a trend I expect to continue in the foreseeable future.
Okay, good stuff. And thanks for mentioning that because, yeah, I mean, the share price is appreciating. You're costing the company more to buy them back from the wider market. Okay, so what about the implications for the wider implications for the equities market?
Well, since the share buyback was announced, we've seen the equities market increase by about 3%. So now it's a bit difficult to say whether this is basically because of the share buyback or still because of investors looking for yields. Now, I believe it's still because of investors looking for yields because most portfolio managers, as we've seen, most local investors have actually shut down their books for the year. So that is one rationalization behind the share buyback scheme of Dangote Cement not actually having as much of an impact on the equities markets today.
All right, so what if other companies, I mean, you've mentioned the US market, for instance, something that goes on there, and it's actually criticized quite a bit by a number of people over in the US. But what if other companies on the Nigerian Stock Exchange, seeing what Dangote Cement has engaged in now, what if they decide to carry out share buyback streams? Are there any risks or implications for investors?
Okay, for investors and for the larger equity markets, it's unlikely we see a knock-on effect, even though Dangote Cement or Dangote Group as a whole is a trailblazer in Nigeria. And this is primarily because not a lot of companies have the retained earnings to actually go on the open market to go on share buyback schemes. Dangote Cement actually said that they had, going by their statements that was released in September, their Q3 statements, their 9M statements, it was actually shown that they actually had in retained earnings a cash and cash equivalent of about 176 billion naira. So yes, not a lot of companies actually have that kind of retained earnings to pool or to go about a share buyback on the open market or through shareholders.
All right, great. And just for the sake of our viewers, you take your net income and you've got two options. You either pay some of it out as dividends, or you keep some of it, which is retained earnings that you've mentioned. So okay, that makes sense. Not all the companies have that capacity to be able to carry that out. Only a number of blue chip companies. This, of course, is the most capped the largest company by market cap on the exchange. So they probably have the wherewithal to do that. I do want to switch to the interest rate side of things now, fixed income and so on, and money markets. The open buyback and overnight rates, I think about a week ago, increased to the 4% range, then declined by about 300 basis points down to 1%. Could this be an inflection point for the general level of interest rates? And what impact will that have on the performance of the equities market that some people consider to be an asset bubble?
If we look at the OBB rates, the overnight rates, they are more indicative of the short-term liquidity at the interbank funds market, and not generally it doesn't say anything about the general interest rate environment. So this increase, this spike that we saw on Friday is unlikely to have an extended effect on equities markets, seeing as local investors or investors generally don't even have access to the overnight markets. So now, moving on from that, I think I'll be a lot more, I would encourage people to look more at things that can actually affect equities markets in the long run. Policy signals, for example, we talk about the bid volumes on the treasury market, in the primary market, and also bond auctions. The volume of those bids, and also the stop rates on those bids at the time they conclude. So those are a lot more. Those are indicators. Those are signals that we can look at that can actually tell us a lot more about where the equities market will end up in the foreseeable future. Okay, great stuff. So Seyi, just to follow up,
So going by those long-term clues, if we do see, leaving the open buyback rates and overnight rates aside, if those long-term clues do play out, and we see stop rates for treasury bills, rates for sovereign bonds and so on, if those rates start to go up, Seyi, are you saying that could tempt investors who are in the equities market to pull some money out and move over to the fixed income side? Is that the gist of it, if that plays out and we do see rates go up?
Now, historically speaking, we have seen that an increase in interest rates generally actually leads to a decline in performance of equities generally. And while it's not a straight line, I mean, it's not particularly a straight line, but in the end, we expect that, yes, investors would pull out some of their money from equities and invest in the fixed market instruments.
All right, and okay, excellent. So that means there's a lot to look forward to as far as 2021 is concerned, and the interest rates, I guess, interest rate direction that the central bank gives us as far as monetary policy is concerned. Finally, I only have a minute to go, Seyi. I mentioned earlier that some people think that the equities market is a bubble. Are you in that group, Seyi? Do you think most of what's driving the market is... You don't have to get into this. I just want to get your thoughts. You think it's a bubble, or do you think it's fundamentally driven what's happening in the equities market?
Well, okay, in March, we saw the impact of the coronavirus and the effect it had on the equities markets. Now, what happened most likely was that the equities market dipped below fair value, and since then it's recovered a bit, and yes, it has improved and it has gone up and actually recouped some of its value back. Now, it has probably, at the moment, has gone beyond fair value now, and it's way beyond, and it's now what we deem to be an asset bubble. So yes, I think I believe it's a bit of an asset bubble, and we expect it to reduce back to fair value soon.
Fair stuff. Analyst at Financial Derivatives Company Limited, Seyi Omidiora, thank you so much for joining us. Appreciate your thoughts on those stories. See where the equities market goes in 2021.